We've entered unprecedented economic times with inflation at 40-year highs, and people are struggling to make ends meet all around the world. This is a global phenomenon. Why has it happened to us now? What can we do to fix this problem? Who better to discuss these issues with than one of the great economists of our time, Steve Hanke, professor of applied economics at Johns Hopkins University and the senior fellow at the Independent Institute. You can follow Steve at his Twitter handle down below and click on the link in the description. Steve, it's an honor to have you on my show, my new show, The David Lind Report. Welcome.
Well, it's just great to be on this launch of the David Lind Report, and great to see you, David.
Great to see you as always, Professor. Like I mentioned, you are one of the great economists of our time. You've worked for Ronald Reagan as one of his economic advisors. Among other accolades, you've helped restore many broken economies in the past, economies that have suffered from hyperinflation, that have suffered from currency collapses. And we'll get to that. We'll get to exactly how you fixed those problems in the past. But first, let's talk about the present. How do we fix the problems we're facing today? Let's hone in on America first.
Well, if we hone in on America and look at let's look at the outlook. Let's put it in that perspective. If we go back to 2020, 2021, what was going on? The money supply was exploding. The average annual growth rate in the money supply was 17% per year in 2020, 2021. Now, 2022, what's happened? The Fed switched gears. Money supply is falling like a stone. The average annual decline in 2022 has been 1.2%. So we've gone from an unprecedented excess growth in the money supply to an unprecedented contraction in the money supply. We haven't seen a contraction like this since the 1930s. It's unbelievable. And we've never had an explosion in the money supply like we did in 2020, 2021. And why am I talking about the money supply? It's all about the money supply. Forget all the noise that you're hearing out there about this thing and that thing going on. Focus on what's going on in the money supply, and you'll get a handle on what's going to be happening in the real economy and what's happening with inflation. Because after changes in the money supply growth rate, with a lag of about 6 to 18 months, we have changes in economic activity that show up. And with a lag of about 12 to 24 months after the money supply starts changing its growth rate and its trajectory, we get inflation changing its course. So at present, it looks like with this huge decline in the money supply, we will see a recession in 2023, this year. And John Greenwood and I, as you know, I work with John on these things. We've revised our inflation forecast. We thought that the inflation would end 2023 in the US at about 5%. Now we think that range will be not 5%, but in a range of 2 to 5%. So we think the inflation thing is coming out of the picture much more rapidly than we originally thought. And the reason for that is that the Fed is not watching the money supply. They just keep squeezing. And yesterday we had testimony by Chairman Powell, Chairman of the Federal Reserve, indicating they were going to even squeeze further. And if you look at the Chicago Mercantile Exchange Fed funds futures prices and calculate the probability of what the change in the Fed funds rate will be at the next FOMC meeting, which is in March, all of a sudden that thing has jumped up to 73% now, 50% basis point. 50% basis point increase. And it was much lower than that before his testimony. And by the way, the best way forget about what the chattering classes are saying about what's going to happen to the Fed funds and so forth. We know objectively what people with skin in the game think is going to happen. And that's by looking at the Chicago futures, the Chicago Mercantile Exchange and those futures market. So now it looks like they're going to keep squeezing. And as I said, the money supply is already contracting. It looks like it's going to contract even more. That means recession. It also means inflation will come down faster than most people think. So that's kind of the outlook. It's all about the money supply. That's the main thing. It's all about the money supply. And by the way, David, the important point on that is that I've been studying, as you know, the relationship between money supply growth and changes in inflation for a long time. And one thing I'd like to note is that the inflation is, you started the program by saying it's a global problem. Well, no, inflation is always a local problem. It turns out a lot of locals are copying the Fed, and as a result of that copycat kind of thing, we have a lot of inflation around the globe. But you don't have it in China, for example. They have a much lower inflation rate than the US. You don't have it in Japan. You don't have it in Switzerland. And why don't you have the inflation boogie or monkey on your back? Because the money supply is growing more slowly and been controlled in China, in Switzerland, and in Japan. And I've looked, by the way, recently, I completed a big study of 147 countries from 1990 to 2001. And I looked at changes in the money supply and changes in the price level, inflation. And I found that the correlation was 0.94%, almost a one-to-one perfect correlation between changes in the money supply and changes in inflation. Now, what does that mean? Remember, we've talked about this before. The quantity theory of money is MV, money times velocity, equals PY, the price level, times real economic activity. And it simply means if changes in M are almost perfectly correlated with changes in P, the price level, that means that the velocity V and real economic activity are pretty stable. They don't change much. Those are kind of constants. So it's all about money. If you look at the changes in the money supply, you're gonna come pretty close to where the changes are going to be in the price level. That's really the end of the story.
I want to break down some mainstream definitions of inflation because everybody is wondering why on earth their living costs have gone up. This is a definition from the New York Times published in an article in September 2022. It says, what causes inflation? It can be the result of rising consumer demand, but inflation can also rise and fall based on developments that have little to do with economic conditions, such as limited oil production and supply chain problems. Nowhere in that paragraph does it describe the causal effect, the cause and effect, rather, of an increase in the money supply on consumer goods. Why is that? Why have they left that out?
Because they don't know what they're doing. You're quoting a journalist from the New York Times. What? You got to get serious, David. You have
help
to
us understand
my 95% rule. Hanke's 95% rule is 95% of what you read in the financial press is either wrong or irrelevant. And what you just quoted is wrong and irrelevant.
Well, the 5% is on this channel. The 5% is on this channel because you're on it. But yes, I understand. Okay, actually, but help us break down exactly why they're not getting it right. I mean, you go to school, you're taught supply and demand.
Price changes.
Yeah.
Not inflation. Inflation is an aggregate. It's not what's going. It's like looking. There are a basket of over in the United States over 300 items in the basket that they have to calculate the consumer price index, and the basket moving up and down is inflation. That's the price level. What's going on inside the basket? All this moving around: oil prices, medical costs, tuition at colleges, computer costs. All these things are moving all over the place. And those are relative price changes that may or may not have anything to do with what's going on with the general basket. The general basket is moving up and down because of changes in the money supply. I just went through that with 147 countries. It's almost a perfect correlation. Change the money supply, and you're going to get the basket changing. That's what moves the basket up and down. Now let us talk a minute about relative price changes to show you how silly the New York Times thing is and misleading it is. 1970s, we had two oil crises in the world because oil is a world market item. And if we go to Japan, we have a perfect case study of this relative price change thing going on. In 1973, that was the first oil embargo. Oil prices shot up, and the Bank of Japan decided, oh, we better accommodate this increase in the oil price going up, this relative price going up, by increasing the money supply. They did increase the money supply. And what did you have? You had not only the oil price go up, but you had inflation going up in Japan. Then in 1979, we had another oil price, OPEC crisis. And the Bank of Japan that time said, look, we're not going to make the same mistake we made the first time. We're not going to make any change in our monetary policy. We're not going to so-called accommodate the oil price going up. Bang. They didn't have inflation. The oil price went up relative to everything else in the basket, but the basket didn't move much because the Bank of Japan didn't goose the money supply to accommodate this unusual price increase in oil. So that's how to be thinking about these relative versus absolute price changes. The absolute thing is the price level, it's inflation, it's the so-called basket of everything they're looking at and measuring. What goes on inside the basket is all this shifting around and so forth. And by the way, if we look at the inflation picture, let me just go through a few things to get this idea that it's not global. It's not global. United States, the inflation rate currently is 6.4%. Canada is 5.9% because Canada they copy everything going on in the United States. They don't have an original thought up north of the border. So that's 5.9%. Now, China is not a copycat. They're watching the money supply. What is the inflation rate in China? 2.1%. 2.1%. Eurozone, copycat, copying the Fed, 8.5%. I'm sorry, 8.5%. Japan, they're not copying the Fed, 4.3% inflation. Switzerland, they're not copying the Fed, 3.4% inflation. United Kingdom, big copycat, 10.1%. India, not really copying the US. It turns out their inflation is about 6.5%, which is, it is 6.5%. It's not about 6.5%. It is 6.5%, which is almost the same as the US 6.4%. So you get all these inflation rates, the basket levels all over the place, depending on what country you are in and whether they're following a policy that's similar to the Fed. If it's similar to the Fed, the inflation is going to be more or less similar to the Fed. China is a big outlier. It's a huge country, and they're not following the Fed.
Okay. How did you fix the hyperinflationary problems in some of the countries you've worked in, the developing countries? I think you've been in Yugoslavia, for example, right?
Right. And Yugoslavia, they had an inflation problem. The inflation rate was 313 million% in January of
I think the word problem is an
2014.
understatement there.
Yeah. So right. It was the third highest hyperinflation in world history, actually. So one part of Yugoslavia, the rump Yugoslavia, after the Balkan Wars, was the rump Yugoslavia was composed of Serbia and Montenegro. And I was a state councilor, part of the government of Montenegro in 1999. And we dollarized the country. We made the German mark the local, the legal tender. And as a result of that, of course, everybody got out of the Yugoslav dinar and into the Deutschmark right away, and inflation was crushed immediately. So that would be one example. Estonia in 1992, and Lithuania 94, Bulgaria 97, Bosnia-Herzegovina 97. All of those places, I put in currency boards, and currency boards are where you issue a local currency and you anchor it with a reserve currency, and that anchor is exchangeable and convertible with the local currency at a fixed exchange rate, and it's credible because you have reserves at 100% of the local currency that's being issued. So you know if you want to exchange your local currency at the fixed exchange rate for the anchor, they'll be good for it because they have 100% reserves. It's like the Hong Kong Monetary Authority. That's the way the thing works in Hong Kong. Hong Kong dollar is worth 7.8 Hong Kong for one US. The US is a reserve currency, and at that fixed rate, 7.8 to 1, you know you're going to be able to get your US dollars in exchange because the Hong Kong dollars are 100% backed with US dollar reserves. So we did that in Estonia, crushed the hyperinflation, crushed the high inflation in Lithuania, crushed the hyperinflation in Bulgaria, and did the same thing in Bosnia. I've done another dollarization, by the way, in 2001, and that was the one in Ecuador. That crushed a triple-digit inflation. So it works. You basically, with the currency board, you make the local currency a clone of whatever the anchor is. And if that's the case, the inflation rate goes down to what more or less whatever the inflation rate is in the anchor. Or alternatively, something quite similar is dollarization. If you use a foreign currency rather than the local currency, the local inflation rate is going to be about the same as in the country whose currency you're using and have adopted locally.
What is the criteria for selecting an asset or a currency to be the anchor? A lot of people were talking about using Bitcoin as an anchor. Is that possible?
Well, it's possible. Have you ever been on a roller coaster before? What kind of anchor would Bitcoin be? You'd be flying all over the place. No sane person would do that. Now, the Bitcoin evangelicals, these religious folks that are on Bitcoin, of course, they would adopt it because that's part of the dogma. The dogma is Bitcoin. So they think that's a stable anchor. No, it's a highly speculative asset, very risky asset. So if you went to commodity, gold has obviously been around for thousands of years, and that would be one option. Or if you went to commodities, it's conceivable you could design a very stable basket of commodities, you see, and anchor it to the basket. So that would be the way to go. But to your question, your question was, well, how would you solve the immediate problem we have now? And you kind of got out in the theoretical weeds. Oh, how about a commodity? Well, they're not really talking about commodities. They're not, and you got to be kind of in fringe schools to be talking about gold and things like that. People do, and it's certainly something that we're talking about, but it's kind of for the classroom, shall we say. What really is the key point now, and the rule should be keeping the money supply growing at a rate that's consistent with meeting an inflation target. And to do that in the United States, the inflation target is 2% in the United States. And you would grow the broad money M2 at about 5%, maybe 6%. So that's what they should be doing. Now they're contracting it by over 1% per year.
Help us figure this out, Professor. Talk to us about the direction of the U.S. dollar. Now, if you're living in America, you'll notice that your dollars have had a decline in their purchasing power because of inflation domestically. But if you look abroad, the DXY, for example, which measures the dollar versus a basket of other currencies, it's at the strongest level in 20 years. So why is it that we have inflation here domestically, but our currency is so strong when you go abroad?
Well, number one, inflation is a lot worse every place else. Current currencies, there are two sides to a coin. There's the dollar, and then there's some other currency. So inflation is worse in a lot of other parts of the world. That's one reason that the dollar is strong. The other reason is capital flows. People want to get in U.S. dollar denominated assets. So if the dollar, if the capital flows are coming from other currencies into the dollar, it gives a dollar strength. And just look at what happened yesterday. We had Chairman Powell testifying about how hawkish he was going to be. And you could see that was factored into the market. Now they think the Fed funds rate, there's 73% chance that it's going to be 50%. 50 basis points, not percent, 50 basis point increase in the March meeting rather than a 25% basis point increase. Now, what's that do? That makes the dollar more attractive because interest rate differentials, the differential starts favoring the dollar more and more as they start pumping up the federal funds rate. So the dollar right now, I think the fair value of the dollar against the euro, which that's the most important price in the world, is the dollar-euro exchange rate. And I think the fair value is between about 120 and 140, something like that. Where is it now? It's about 105. The dollar's hugely strong. And it's been that way all during this inflation period, by the way. It's been much stronger than what I think the fair value 120, 140 is. And as you say, it's almost at a, not an all-time high, but it's very strong right now. And that's all an interest rate game.
I want to finish up the discussion on the economy and then move on to education and your gold sentiment index. Professor Hanke has a very interesting index, which we'll talk about in just a minute. I want to finish up this discussion on your recessionary outlook. Now, I'm confused on how to feel because on the one hand, you're telling me inflation's coming down, which I should be celebrating because it means, I guess, my living standards may or may not improve based on the relative prices that we're talking about. But on the other hand, you're telling me there's a recession imminent. So I'm conflicted.
Yeah.
Is this good news or bad news?
You shouldn't be conflicted. The Fed's doing the wrong thing. That's why you're all mixed up. The Fed is saying they want to increase interest rates. They're not, and that's going to fix inflation. They're not looking at the money supply. They're flying blind. And in the meantime, as they increase interest rates and keep squeezing things, the money supply keeps contracting. And that's the signal. That's the signal. You can't confuse, David. You're confusing signal and noise. You're listening to the noise and not paying attention to the signal. The signal is what's going on in the money supply, and that's contracting, and that means with a lag of 6 to 18 months, the economy will contract. It also means with a lag of 12 to 24 months, inflation will come down. So this has been going on now all year, this contraction and slowing down of the money supply. So we know with these lags that are very, okay, there's a big range in the lags, but we know what's coming down the pike. Economy slowing down and inflation slowing down.
Two-part question. What causes recessions, and how bad is the next recession going to be?
What causes it is contractions in the money supply, excessive squeezes. I said to hit the inflation target and keep the economy growing at a steady rate, they should be growing the money supply at about 5 or 6% in the U.S. What are they doing it? They're contracting it by over 1% per year, which we have, by the way.
So they're overshooting.
They're overshooting. It's an overshoot, and they don't know they're overshooting because they're not even looking at the money supply, and very few people are looking at the money supply. They're looking for clues of what's going on in all the wrong places. All the wrong places. You've got to adhere to the quantity theory of money. That's what it's all about. If you want to understand where nominal GDP is going, that is the GDP with the inflation component and the real component included, you must have a model. And the only model that's any good is the quantity theory of money. MV equals PY. That's the end of the game.
All right.
And based on, let me remind you that John Greenwood and I used MV equals PY, and we were the only ones to hit the nail on the head and forecast the inflation problem that we were going to have in the United States. We did that in advance of everybody else, and we did it with, as you know, we had numbers. We said the inflation was going to be between 6 and 9%, and that's exactly what happened. Okay, in June of 2022, it did go up to 9.1%. So we were 0.1% off on the top. But, you know, I mean, give a guy a break, you know.
Close enough. Okay, going back to the recession, how bad is the next one going to be? Some people say we're already in a recession. You're saying it's on the way. Is it going to be as bad as 2008?
If they keep squeezing, it's going to be bad. And given what Powell is telling us, and the fact that the Fed is flying blind, I think they've already over squeezed, and it looks like they're just going to continue doing so. And in that regard, that the longer they keep squeezing, the deeper the recession will be, and the longer it will last.
The White House keeps denying that we're entering a recession, and in fact, they're looking at the unemployment rate as one indicator. They're saying it's still low. 3.4% is right. It is currently still low. Are they right? We have nothing to be worried about. The labor market on paper looks strong.
Absolutely wrong. They've been wrong since day one. They never anticipated inflation. Remember Team Temporary? They said it was due to a little supply side shock or something in China. I don't know what their reasoning was, but they never looked at changes in the money supply. They never anticipated inflation. And now they're giving us lessons about how strong the economy is. The job market is very strong right now, but that's a very lagging indicator. That starts changing after the recession already hits. It doesn't weaken before the recession. It's a very lagging indicator that drags along way after the economy starts tanking. You don't fire people before the recession. You fire them after you're in the tank.
I guess if you're a smart business owner, you talk to Professor Hanke, and then you foresee the recession, and then you lay people off. But to your point, yeah, most people don't do that.
Yeah, exactly. So number one, would you actually believe anything coming out of the White House?
I'll let you answer that. You've had more experience working with them than I have.
I think, remember my 95% rule. 95% of whatever comes out of the White House is either wrong or irrelevant.
I want to shift gears and talk a little bit about education, which is, if you're talking about the public school system, under the purview of the government, which you've just discussed, we can't really trust. Now I'm going to quote Nelson Mandela here. Education is the most powerful weapon you can use to change the world. How would you evaluate the state of the education system in the United States today? I ask you because you're well positioned to answer this question. You are a professor at a top school, Johns Hopkins, and just recently Columbia just announced that they would eliminate the requirement for SATs. They would still look at it, but you're no longer required to submit SATs to Columbia. I don't know if other top schools are going to follow suit. I don't know about Johns Hopkins, but certainly this seems to be a trend. Help us figure out what's going on with the education system.
Well, first of all, just on the SAT scores, to show you how low the level is sunk, can you imagine what if you had a track team and you were trying to recruit people to be on the team, and you refused, you did away with timing them in the 100-yard dash, you threw away the stopwatch. That's what's going on. It's a throwing away of all standards whatsoever. So what's the state of education in the United States? Is terrible, and it's getting worse. Let me just give you some.
It says, just on that note, it says they're doing it because they want to allow flexibility for students to represent themselves fully and showcase their academic talents, I guess, in other ways. Are there other ways to showcase your talents besides SATs? I don't know. I'm asking.
Well, there might be other ways, but the standard way to do things is to use a stopwatch. Take a test.
Okay.
Take a test. It's a simple game. I mean, if you want to form a football team, American football. I'm not talking about European or Canadian football. Well, actually, Canadian football is American football, but I've forgotten about that. But at any rate, let's say you were forming a football team, and you didn't do strength tests, speed tests, weight tests. You didn't do any of these objective things, and you got some 40-pound weakling on the team because you didn't have a test, and you let them express all their talents that they might have that you couldn't take on a weight test, speed test, et cetera, et cetera. Why you would throw out some objective measure is beyond me. It's just lowering the standards. This is all part of, by the way, this grade inflation has been going on in the United States at universities for a long time. I mean, I'm an old timer, but when I went to university, if you didn't do well in a course, you received a letter grade of F. That's flunk. They flunk you. Now that's almost unheard of. No one at university gets Fs anymore.
Well, maybe everyone's just smarter. I don't know.
It doesn't appear that way to me. But at any rate, let me give you some examples from. We're talking about this public school systems, government school systems in Baltimore. I'm talking to you from Baltimore now. Johns Hopkins University is in Baltimore. The CEO of the Baltimore public school system earned last year $445,000. $445,000. The school system has 78,000 students. It's the 44th largest system in the U.S. In 2019, there were 1,207 employees that made over six-figure numbers. That's over $100,000 a year. That increased, by the way, in 2021 by 36% Now there are 1,645 employees that earn triple-digit pay. So the pay is sky high for the teachers. How about the performance? The graduation rates have fallen down. Only about 69% graduate from high school. This is high school we're talking about. The attendance rate is down at only about 81%, even attend, even show up for school. The college enrollment rate of the students coming out of the Baltimore public school system has dropped down to only 41%. Now, what about the performance in terms of reading and writing? We have 2022. 0 students are proficient in math at grade level across all 23 schools in the Baltimore system. 0 are proficient in math. 0 are proficient in math. 93% of the 3rd to 8th graders they tested below grade level in math. It's the lowest level in the state of Maryland. So it's just a complete disaster, a complete disconnect. You have very high pay for the teachers, and that's why the cost of education goes up so rapidly, and the performance has collapsed because there aren't any standards. No one even holds them accountable to go to school. The students don't even show up for school. The attendance is way down. So it's a complete disaster. And Baltimore is only one major city in the United States, but if you look at all of them, whether it's Chicago, Los Angeles, what have you, you're going to find roughly the same thing. Very high pay for teachers, very low performance by the students, going down, sinking. And why is this in the public schools? Most of the public schools are unionized. The teachers' unions run these things.
Are you concerned for the future? Are you concerned about the next generation, or for the next generation?
Yes, you quoted, I think, Nelson Mandela a minute ago, and I completely agree with Mandela. If you don't train somebody, it's like let's take a simple example. Let's take a factory job that requires some training to be proficient. What if you don't train people? What if you throw out the training manual and say, oh, go in there and do whatever you want to, do your best, see how it works. It doesn't work. You have to follow what I call the 5 Ps. Prior preparation prevents poor performance. And prior preparation involves schooling and training and standards.
Maybe we'll coexist with robots and AI and they'll do most of our work for us. I don't know.
Well, I mean, that is, by the way, that is one reason that the AI, of course, is a new technology, but one reason behind the scenes that they're pushing this is because a lot of people, for example, what do you do even at a McDonald's? If you try to hire some young person and they're illiterate, they can't read and they can't write. That means they can't make change. They can't take an order right. And you can correct that by training, but now my guess is the government's probably got its nose in the whole training thing. And
well, final question.
The way things are going, they would probably make training illegal.
So how do we fix this problem? Is it do we need to motivate the kids to perform better in school, or do we need to, I don't know, set some sort of standards for the teachers to be more rigorous in the classroom? Speak directly to the audience now. How do we convince the kids to do better and the teachers to? Yeah.
Well, if it all revolves around the teachers and the curriculum. You've got to teach the ABCs: reading, writing, and arithmetic. That's reading, writing, and arithmetic. Forget all this social science nonsense that they try to shove down their throats. And you have to have qualified teachers to do it. But the teachers unions, that's not the case, because if you're a lousy teacher, you can't, it's impossible to fire them. You have to have qualified teachers with a sound basic curriculum, reading, writing, and arithmetic. And if you did that, by the way, students are not stupid. Young people are not stupid. If they knew they were being offered a product that benefited them, they would be attending school. But one reason they don't attend school, they know it's a lot of garbage they're getting at school. There are no standards. There's a lousy curriculum. The teachers are lousy, and what have you. And as a result, the students aren't attracted to it.
Do we even need college in today's society?
Well, yes, I do think that we do, and you know, as a college professor, I can tell you, I know what I'm doing in my classes. My classes are very well known throughout the country, written up in the Wall Street Journal, and Barron's, and other places, and I know all of my students. I'm teaching finance and economics. They all go, the bulk of them, to Wall Street at their top jobs, or alternatively, a lot of them now are going into consulting of one form or another. And there's another smaller group of them that are more entrepreneurial, starting their own businesses and things like that. But they are getting. I am quite gratified and satisfied that they're nailing the top jobs available, and they're doing that because I am running a professional operation. I have standards. They know what the standards are. They're very attracted to the class because they know they're going to get their ticket punched. If you want to go to Wall Street and you're a Johns Hopkins student and you want to get your ticket punched for that, you take Professor Hanke's course. It's a simple game.
Well, there's another way we can learn from you without going to Johns Hopkins, and that's by going to your gold sentiment indicator, which almost perfectly tracks the price of gold and predicts what it's about to do. Tell us how that works.
Well, what we do, Abe Kaufman and I have developed this, and here's what we do: we measure and track the sentiment in the gold market, and how we do that, we use what's called text mining. Every hour we get all the articles that mention gold, and we text mine those again with, we're not reading these things literally. A machine, as a computer, is reading them for keywords that are bullish or bearish. For example, rate hikes. When we see that is a negative, because rate hikes mean the Fed funds rates are going up, and that's bad for gold, because that means the opportunity cost of holding a gold position is higher at higher interest rates. In other words, recession is bullish, and the recession as a word is bullish because they think the Fed will end up lowering Fed funds rate. Interest rates will go down. So these are examples of a bearish word would be rate hikes. A bullish word would be recession. Now, what we do, we generate every hour a unique gold sentiment score, and I think I've given you some graphics on that. Maybe the extreme bearish would be -10 to -15. Extreme bullish would be +10 to a +15, and then we've analyzed this by the way, 11,000 hours of we've been getting the sentiment scores, 11,000 hours, and what we find is if the extreme bearish score starts popping up, let's say a -6, for example, 0 is neutral. Let's say we go to a -6. That's an extremely bearish signal. That means that the market is about ready to turn around and the price will go up. So it's a contrary kind of trading algorithm. An extreme bearish signal in sentiment, and the Hanke Sentiment Index indicates that the market is about ready to turn around and the price go up. The alternative, an extreme bullish sentiment reading, when it gets extremely bullish, the market is about ready to turn around and the price go down and the sentiment go down. So this, as I say, we've been running this now for some time, a couple of years, and we're tracking in at very high rates of return. The rates of return have been around, depending on the algorithm. It depends on the algorithm. They're in the kind of 30 to 50% per annum rate of return zone, and we offer now a monthly service for $15.95. You get 6 updates a day. You get the sentiment score, and you get the buy sell signals on the algo, and you can find all this, by the way, at just go to www.thegoalsentimentreport.com and you find everything. So we do. It's how you get real fine-tuned sentiment. What's going on hour to hour in the market, and in this case, it's the gold market that we're looking at. And in the short period of time, sentiment drives these markets. The fundamentals drive things over long periods, make the market go up. Fundamentals are behind it. Market goes down. Fundamentals are behind it on longer term trends. But the longer term trends, if you get the thing going up, for example, the gold price trending up on a long term fundamental basis, there'll be lots of wiggles around. During the day, the market's going all over the place, and day to day, the market's going all over the place. We're picking that up with a sentiment, and we're trading it successfully. And depending on the particular algorithm that we've developed, because we've developed a variety of them, the rate of return has been about 30 to 50% on a per annum basis. Actually, some of them have been higher than that, but conservatively, I think I'm comfortable with saying 30 to 50% would be something one could anticipate.
All right. Thank you, Professor Hanke. We'll end it here today. Very good, thorough analysis of the economy, and thank you for your time and for educating us all. Appreciate it.
Thanks for having me. Great to see you, David. Good luck with the David Lynn report.
Thank you. I appreciate you being on here and helping me grow my channel, and I'll have you on soon to give us an update. And thank you for watching the David Lynn Report. Stay tuned.